Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. In today's video, we're going to be diving into some insights, discussing and talking about the future financial landscape. As always, bringing you all some of the realest information in the game, showing you guys that the financial industry is completely changing. There's a massive paradigm shift, and studying these new technologies, testing them yourselves, and starting to integrate them into your everyday lives would behoove every listener tuning in to the CYPRX YouTube now and moving forward as we head into the 2030 agenda. So we're going to be diving into some insights from the likes of Deutsche Bank, Franklin Templeton, Commerce Bank, highlighting their perspective on strategic implications of this new wallet-based system that we're headed into. We've been discussing and talking about this for some time. And so today's fundamental digest, these highlights that I'm going to share with you guys today, are going to cover exactly that to get the mindset right. Now, over a year ago, I posted something on X, I believe it was either in June 2024 or July 2024, where I made a statement saying that the DeFi ecosystem on the XRPL is going to continue to be well-developed, more mature, and built out at a granular scale over a prolonged period of time. Now, fast forward to more recent times, we had Jazzy Cooper, the director of product management at Ripple, go on to talk about how they are expanding the XRPL's lending capabilities and launching XLS 66 on the XRPL. And I said, finally, right? Finally, we're going to start to see lending capabilities where users can lend out their assets, borrow against them, and maintain upside exposure while copying a tax break with their digital assets. We're entering into this era where we are going to become our own banks. We already can. However, a lot of people still don't understand that this is possible. So it would, again, behoove you guys to start to digest this information and pay attention, because projects, organizations, and companies that you already know and trust are starting to integrate these DeFi primitives into their backend infrastructure.
We're introducing a new lending protocol to the XRP ledger. It will allow for credit origination on chain. And the way that it works is basically users can deposit capital into a single asset vault and receive a share token, just like, one side of the automated market maker. And then essentially you can have what's called a loan broker that will create a new loan for a particular borrower. And that will remove liquidity from the single asset vault and create a fixed term interest bearing loan for a particular borrower. In terms of risk management, there's a couple different paths there. You can do off-chain underwriting, or you can have.
Right. So I'm not going to bore you guys to death, but you get the picture. And then following that announcement, we had this announcement, which again just goes to show strategic implementation and maturation over time. ImmuneFi and Ripple announced a $200,000 attackathon to secure proposed XRPL lending protocol. Ripple and ImmuneFi are collaborating to launch a $200,000 attackathon to secure the proposed XRP lending protocol as part of the institutional DeFi roadmap. This program is a timed box adversarial competition where security researchers dive into the code to ensure the protocol has the strongest possible security posture, surfacing vulnerabilities before they reach production. All right. So this again just goes to back what I said over a year ago now, that we're going to continue to see DeFi developments on the XRPL mature over time. And we're seeing this now in real time. To support my thesis, this is Marshall Hayner discussing and sitting on a panel discussion with the Deland CEO, or CIO, if I'm not mistaken, John Ungerlin, and he goes on to talk about this future that we're headed into, where we're going into a world where instead of borrowing against thin air that the banks create, you borrow against hard assets that you already own.
Right? Young people get these cards, they get in over their heads on the debt. And if you think about in the future, what would happen in a credit-based system? What would happen in a system where, instead of borrowing against money that you don't have, you borrow against the crypto that you do have or something? And that's really kind of the advent of decentralized finance. I think, what was missing in this was the compliance components, the digital identity, the anti-money laundering built into the blockchain technology itself. That was the piece that was needed to integrate with traditional financial services.
Right. And so, again, a lot of people are in this stage where they're still transitioning out of this mindset that existed before the advent of decentralized finance and became start kind of like mainstream in the crypto niche, where everybody had this mindset where they're going to hold their crypto assets for whatever prolonged period of time you had in your mind and then sell eventually for fiat currency and become financially successful. Well, that mindset is dead and decaying as we've seen fiat currencies depreciate and devalue at a rapid pace over the past consecutive years. And that's likely to continue as printing and debasement of currency is most likely to continue as we progress in this financial system. But a lot of people are still in this mindset and need to hear that this is not what the wealthy, they don't look at their wealth in terms of cash, how much cash they have. They look at it in terms of the assets that they have, and what they do with their assets is they lend them out, they borrow against them. Don't take that from me. Again, take it from people in this industry that have credentials, that have worked with financial institutions directly and indirectly, and are telling you guys this on their panel discussion.
Well, I think I wholeheartedly agree with you on never wanting to sell Bitcoin. And I think, just to elaborate on that, the play that, the very wealthy did over the last few decades was you hold your assets, you want to hold financial assets because as the dollar has been continually
Exactly.
deprecated and depreciated, that pushes up the price of financial assets. One way inflation manifests itself is that the price of Apple stock goes up, right? Because a dollar is now worth less than it was before, which means the price of everything has to go up, including financial assets. So the very wealthy don't denominate their wealth in dollars, as in they don't keep it in cash in the bank. They keep it in financial assets or real assets, which appreciate. And I think for our generation, millennials, Zoomers, the newer generations coming through, a lot of them are priced out of the real estate market, which was what
Yep.
boomers accumulated most of their wealth in, and instead they're looking at alternatives. Real estate can't appreciate at double-digit compounding rates for the next 20 years because otherwise you're going to end up in a world where a house costs 30 times somebody's annual salary. So it's just mathematically impossible. However, Bitcoin compounded at 54% over the last 7 years. If Bitcoin continues to compound even at a rate north of 20%, it becomes an incredible asset for the younger generations to own, to accumulate wealth. And I think they should look at borrowing against that in the same way that boomers borrow against the equity in their house. So you retain the upside, you don't cop a tax bill, and you can fund lifestyle purchases and continue to compound your wealth. However, Bitcoin.
So again, a lot of people are starting to hear about DeFi, lending, borrowing, providing liquidity, and doing all these things with our utility assets for the first time. And here at CYPRX, we've been at the forefront of trying to wake people up and get them to realize this is the future. Again, don't take that from me. We're going to head over here before we dive into that document from all of those industry-leading experts. Shout out to Wealthion. Hopefully, I'm pronouncing their YouTube channel correctly for that. They had an interview, Chris Perkins, with Sandy Cole as of recent. This is from 7 days ago. And I want you guys to just listen. Remember, Sandy Cole, her credentials stem from the likes of the World Economic Forum. She has valid credentials at the DTCC, the CFTC, and currently works at Franklin Templeton, right? And listen to what she says in this interview.
Maybe a bit of a challenging question. How do you see Franklin Templeton versus your competitors and your peer competitors? Like, how's your approach different?
Yeah, so I think we're different in two big respects, right? Number one, we firmly believe that blockchain and these protocols are going to be the future utilities for the entire world, right? I don't believe in 15 years, 20 years, any organization, company, government, small business, individual, none of us are going to keep our own books and records, right? This is going to all be on public blockchain. These L1s and L2s that are out today, they are becoming, to us, the utility ledgers for the entire world. And so we are moving our whole thinking towards this infrastructure, which means no more accounts, all wallet-based. We believe that the entire future is going to be operated out of cryptographically protected wallets. And that means that every asset that sits in that wallet is going to be either a digitally native asset, a cryptocurrency, or a tokenized asset. And therefore, they are going to be interoperable. They're going to be commingled. They're going to have greater utility. They're going to settle instantly. They are going to be able to be easily transferred, and they're going to be able to be pledged in terms of collateral or liquidity pools or staking pools. There's going to be so much more that we believe people are going to be able to do with their assets. And so what we're doing is we're really building our future state infrastructure inside of our current infrastructure. And so
So all the vocabulary that she just said, staking, earning yield, providing liquidity, these are all DeFi primitives that you guys in the moment should be learning if you haven't learned them already. And again, it does not require you to go out and risk your hard-earned assets to do so. If you want to take a mentorship approach because you don't know where to find good, valid information on how to do these things, you can head over to CYPRXtrading.com and you can tap into the Wealth 28 Club with us, right? We've helped thousands of people understand what she's talking about. That's all you have to do to prepare for this new financial era that we are headed into. She mentioned that in the future, everything is going to run through cryptographic wallet-based systems. And I cannot stress enough that that is exactly what we're going to dive into in the document today, but that is where the future is headed. Now, another thing that she mentions in this podcast, because again, I'm trying to make video content moving forward that you can share with a friend or family member that's skeptical about crypto. Keep in mind, again, this lady has a chair board supervisory level experience at the DTCC, which is the backbone of the US financial system, the World Economic Forum, which obviously, of course, if you don't know, the World Economic Forum is like one of the biggest like elite organizations that runs the decision making for this world, right? The CFTC, which is a regulator in the United States, and Franklin Templeton, which is a $1 trillion asset management firm, okay? That's where this lady comes from. And here she is right here saying that this is not a scam anymore. Anybody that thinks that this is a scam is, again, falling behind the education curve, and they need to do more research. Take a second and listen to what she says here.
in the cloud and the entire industry will be on blockchain.
And the internet wasn't safe in the early days. I remember in my college dorm room when it first came out, like there was no way I put my credit card on there. It would be gone.
Yeah, that's right. But if you kept that view, right, if you kept that 1994 view of the internet, in 2004, you were having a losing business proposition, right? That technology improved so quickly that you were way behind if you hung on to that view that the internet was dangerous. And that's the situation we're in today. There's a lot of firms that are hanging on to this view that Bitcoin, that blockchain, that these are dangerous technologies. And they're not appreciating how much and how institutional these technologies have become over the past decade.
Yeah, I mean, I talk to people all the time and they're like, crypto, Bitcoin, it's like one and the same. And there's just such a lack of knowledge, and it's amazing to see you so far out in front. You know, you talked about tokenization as a core part of
Right. So Sandy Call just confirmed that these things are not a scam. These things are not to be taken lightly, and you should be educating yourself on it and shouldn't have an outdated perspective that these things are dead in the water or that they're going away. The last thing that I want to bring to your attention before we head over to the document is, do you guys remember I posted a video breakdown from the Centrifuge Summit that took place just a couple of days ago of Monarch Asset Management openly confirming that in 2025 they are actively participating in DeFi looping strategies. Remember, this is an asset management firm discussing and talking about the same terminology and vocabulary that we talk about, and show you guys examples of how we are participating in these same strategies, looping to maximize yield in the Wealth 28 Club. Listen to what this gentleman here says.
To compensate for the risk, right? And which is why what ends up happening for us is we end up looking at real world assets, and almost always we are looking to loop it, right? So, and I know it's not a security question. So in fact, we're actually adding more risk, right? But we like to loop it so that the yield is higher than what it would be traditionally in just from the asset itself, right? So and looping means basically depositing, rehypothecating the asset, depositing it somewhere, borrowing USDC against it, and buying more of the same asset, and so on.
How they're participating. Right. So that video breakdown was from a few weeks ago, but now again, fast forward to Sandy Call, she comes in with a banger and confirms that this is going to happen. So we're going to jump to 16 minutes here, and then I want to read one little tiny piece of the document that I have for you guys today.
the benefit to your consumer. Is this just like a cost of doing business where you want to give your client a good experience, or are you able to create new businesses and P&L and revenue around these innovations?
Well, it's really both, right? I mean, on one hand, we're going to be giving our clients a better experience because their assets are going to be in their account faster. They're going to be able to do more with it. And in many cases, they might even have to pay less in terms of fees, because all the costs that I have to cover today to account for the risks that might exist in that 24 hours before I actually own the equity, I don't have to cover those risks anymore, right? So it's going to be cheaper, I think, to trade. It's going to be easier for me to have my assets available immediately and do more with them. And I think it is going to enable new types of investment strategies and new types of passive income streams and new business models that just aren't possible today, because it's too difficult to actually move these equities and these other investments around sufficiently easily for us to design new things, right? So having this increased this ability to transport things more seamlessly is going to open up the creativity of us to design all new strategies. And we're already seeing this with fixed income instruments, right? With yield-bearing instruments. We're seeing new models like looping, which are actually allowing us to compound yields and to layer yields on the product, which is something we were never able to do before this. So it's a really exciting time to be thinking about what the future of finance holds.
Yeah, so let's talk about this looping example. I think it's really important because it's an obvious.
Now, Sandy Call goes in to get asked the question, what is looping? And she explains and breaks that down. But if you don't know that terminology, you don't know what looping is or how to even participate in looping strategies to maximize yield generation, again, lock in with us in the CYPRX Wealth 28 Club, because we physically show you guys how we are risking our hard-earned capital in this space to participate in these strategies, so you guys can see that you don't have to go out there and expose your crypto to the DeFi ecosystem. You can watch us take the risk, right? So monumental right there. That is just 110% solidification that what we're showing you guys in the Wealth 28 Club is exactly what the largest industry leading experts in the space are focused on. That leads me over here to this document. Okay, I just want to take you guys down here to page 19 out of 23. This is a document from Finmo, Corporate Treasury in a World of Wallets. And I'm just going to read 2 pages here. It says here, the rise of enterprise wallets. Corporate treasuries are increasingly evaluating stablecoins, tokenized deposits, and tokenized money market funds as a legitimate treasury instrument. While adoption remains measured, the implications for treasury operations are becoming clearer. The traditional bank account, which has anchored corporate liquidity management for decades, now faces competition from a more flexible alternative, the digital wallet. A bank account maintains a single currency relationship with one financial institution. Let's zoom in. A wallet can hold tokenized deposits from multiple banks, stablecoins from regulated issuers, yield-bearing tokens from asset managers, and other digital assets across various blockchains. This isn't merely digitization of existing processes. It represents a structural shift in how corporate liquidity might be managed. Consider the practical implications. Video streaming didn't just digitize and replace DVDs. It fundamentally changed how we consume media. Similarly, wallets don't simply digitize bank accounts. They enable treasury functions that weren't previously possible. Instant settlement, continuous yield optimization, and programmatic liquidity management. So again, this is happening, and this is the world and the era that we are headed into. These are the types of documents, by the way, that you guys should be tapped into and reading, which are all available in our private CYPRX Discord for you guys to do research on via our private CYPRX research team. Now, to end this and give you guys a realistic time horizon on this, again, not from my perspective, this is based off of people that were involved in writing this document, which stem from Deutsche Bank, Franklin Templeton, Commerce Bank, Coinbase, right? All these large organizations that are involved in this space. And it says right here, 2025 to 2028 horizon. Based on current trends and ongoing initiatives, the next 3 years we will likely see. So again, I'm giving you guys this directly from the source. This is not my personal opinion. This is what the experts are saying. In 2025 through 2026, early adopters are going to demonstrate value through successful implementations, regulatory frameworks, clarify in major jurisdictions, account standardization, formally recognizes tokenized instruments as an equivalent to their traditional counterparts. From 2026 into 2027, mainstream adoption is going to begin as proven use cases proliferate. Integration between wallet infrastructure and traditional treasury systems becomes seamless. Competition drives costs down and functionality up. From 2027 to 2028, wallet-based treasuries become a standard option alongside traditional accounts. Hybrid structures that leverage both models become the norm, for sophisticated treasury operations. This is the most important part. It says this timeline is not speculative. Major corporations are already running production pilots. Regulatory frameworks are crystallizing. Technology infrastructure is proven at scale. The question isn't whether this transition will occur, but how quickly and smoothly. So to give you guys an accurate horizon timeline right here, Okay. Between now and 2028, you need to be learning these things. You need to be integrating them, testing them, hopefully incorporating them into your everyday lives. Again, not financial advice, but just go out there and play with the technology with small test amounts. Go out there and read the documents. Go out there and join like-minded communities like the one that we built here for you guys at CYPRX, because this is the future. And you don't want to be in the confusion part of the population that's like, what the heck's going on? Oh my gosh. You want to be the part of the population that grasps these new things and integrates these new technologies to enhance your life. With that being said, many blessings to you guys. I really hope that you all enjoy the real information that we provide for you guys. Non-opinionated, straight from the source. As always, do me a favor, smash that thumbs up button and subscribe. Be cognizant, be aware out there, and I'll see you guys in the next video breakdown.